Hey everyone, I'm Cary Smith and I'm sitting here with Cheri Turner.
Hi, everyone.
And Cheri and I are with Client First Capital. And today we have a topic that I think is on a lot of people's minds. And what it is it's the top 5 mistakes that DIY investors make. So Cheri, um, I'm not that handy. And there's been times at home that I've tried to do my own, small home renovations, or
Sure.
times where I'm trying to do a fairly major repair to my car.
Mm-hmm.
And in those situations, I've been able to learn pretty quickly, right, that I'm in over my head.
Yeah.
And in some cases, my lack of experience or skills actually ended up costing me more than it
Can,
would
yes.
have if I would have just used a professional from the beginning. And I don't think that DIY investing is really that different.
Okay.
Sometimes it might be harder to realize some of the mistakes you're making because the mistakes are just lower performance, not no performance, and
Right.
or maybe increased expenses, but you didn't have a benchmark to check them against. And so it could be things of that nature or missed opportunities, which can be really hard to even recognize that you missed an opportunity. And so we're going to talk about some of the 5 common mistakes, but also, just another thought on this before we jump into the topic.
Sure.
There's a lot of apps and websites out there that people will work with,
Yeah.
and I don't want to, and they're good. They are helpful. They will take an amateur from being an amateur to an amateur plus,
Right.
but they definitely don't get them to the level of a professional asset manager.
So
And
true.
so I really think in the long term, there's going to be a lot of value with working with a professional.
Hmm.
And then we'll discuss some of the reasons why.
Yeah.
So why don't you get us into the topic?
Absolutely. So, in talking about the top 5 mistakes, one of the biggest is emotional investing. So, we tend to be most emotional, especially when it's our own money. But what ends up happening when we do this is we end up oftentimes buying high or selling low. We find ourselves doing panic selling when there's, a shakeup in the market. Or we might find ourselves doing FOMO buying where some stock's doing outstanding. And so you feel like, well, everybody else has got it. So maybe you buy in at the peak and then you end up losing money on it. So not being really well informed can lead to those emotional investment decisions. Another is ignoring or not being familiar with the market cycles. As you're familiar with, Cary, we as a firm spend a lot of money on research to keep track of the economy and the markets and the interrelationship between those. And so for individuals who aren't considering any of that, the market's going to go through ups and downs and they're going to be in and out at wrong times when they're not aware of those cycles.
Yeah, and there's different different things look more attractive during different cycles,
Right,
right?
right.
And so but we're able to take the emotion out of it,
Hmm.
use the research, evaluate the market conditions, plus years and years and years of experience,
Hmm.
right? Can help us so that we're not doing the emotional investing, which is very common.
Yes, very common, very common. So the second common mistake is a lack of diversification, which kind of goes along with that somewhat. But basically, it's having too many eggs in one basket, right? A lot of times, individuals who are compelled to do their own investing oftentimes feel themselves fairly knowledgeable within a certain uh, either field or sector of the economy. And so oftentimes that knowledge might make them feel that they have an advantage. And so they can find themselves heavily vested in those certain types of areas and over concentrated in either certain stocks or certain sectors. And so if you see a drop in that stock or in that whole sector, then your entire portfolio is going to end up taking that hit.
So you make such a good point. So it's very common for people to be kind of over indexed or over invested in the sectors that they're most familiar with,
Hmm.
right? Where they
Hmm.
feel that they're better engaging, the risk in those. And then to be, under invested in the sectors of the economy that they're maybe less familiar with.
Exactly.
And so if they're familiar with equities, they might, but they're not familiar with bonds. It's very common that the bonds they have in their portfolio aren't the best bonds, or the durations aren't right for the current conditions, and or vice versa. And so they typically will trend in the direction they're most familiar, and then underperform in the areas that they're less familiar.
Exactly. And so the third area where we see issues is ignoring tax implications. Oftentimes, these individuals are driven by day trading or looking for those opportunities that they're oftentimes generating unnecessary capital gains. As many people are aware of, your short-term capital gains are taxed at a much higher rate than long-term. So you really want to have a strategic approach to that picture. And you don't want to be doing constant trading to where you're just constantly generating taxable income. There are more strategic ways to do it by placing certain investments in certain accounts that are, not taxed or tax deferred. And so lack of information around those types of strategies means that they end up paying more in capital gains than they ended up having to.
Yeah. So I'm going to add just a little bit to this discussion right here. So it's not just taxes, but it's fees and taxes. And you have to see your profits or your performance be eroded by taxes and unnecessary fees.
Yes.
And both of those things can just eat away at your returns. And so it's just very important to have an overall view of your portfolio. And professional managers are going to be aware of the taxes and not trigger taxes, and make sure you're being tax efficient, but also not taking on any more fees than are necessary. And a lot of times those fees are already included in their fee.
Right.
So you don't even see an additional impact from those fees to begin with.
True. And another point here is that a lot of times these individuals are not familiar with the concept of tax loss harvesting. So that opportunity to take some gains that you had throughout the year and offset them with some opportune losses that really, help you to optimize those capital gains. And so without that knowledge about how to do that, that's another missed opportunity for them.
Yeah, good point, Cheri.
Yeah. So another area is in failing to rebalance. So a lot of times these people might come in and have an idea that they need to establish a certain portfolio and that they need to have, certain categories or certain ranges within there. However, they might just set up that portfolio and then let it go. Well, if you started your portfolio at 60-40, but you don't ever come back and rebalance, the values of each of those things within that portfolio are going to adjust. Some are going to go up over time. Some are going to go down. You can find your portfolio drift all the way to an 80-20 if you're not coming back and keeping an eye on it and making sure that you rebalance and get those proportions back in alignment.
Yeah, Cheri, this actually might even be maybe one of the most important of the topics that you've listed so far. And so, for one, a lot of people who are doing it themselves are using really just kind of like a balancing of 60-40 or 70-30, whatever it may be. And for a lot of people to get the best results, that's a little oversimplistic. Yes. And there's, with a good asset manager, they're going to be looking at GDP and inflation and how those two things performing in other economic conditions, and even adjusting that balance regularly to make sure that you're not taking on more risk than you intended, or not taking too little risk and you're taking advantage of the opportunities. But there's a lot to this. And if you're letting yourself get out of balance, you may be taking on a lot more risk than you ever intended. Yes. Or missing out on a lot of opportunity just because you're not actively managing it.
Yes. And kind of along those lines, Cary, one of the things that these individuals sometimes fail to do, because in their minds they're just looking to maximize their profits or maximize their gains, is that they neglect adjusting for life changes. And as we know, being in finance, as you approach your retirement years, you pull back and become slightly more conservative as you get closer and closer to retirement. Well, oftentimes these individuals don't really approach it from that perspective, and they continue to go at a very high risk. And if you end up having significant drops in those years just before retirement, it's that much harder and that much less time for your portfolio to recover.
Yeah, that's a really good point.
Yeah. And so the final thing about a limitation of people who are DIYers is that they tend to not have a clear financial plan. There tends to be a very heavy focus on investing, but the truth is that your investments are just one piece of your financial picture. And that financial planning and estate planning and risk management are just as important as your investment planning. So really ensuring that you are defining your goals and looking at your entire financial picture and not just your investments.
Yeah, it's important to have a plan. If you want to arrive at a destination, you need a map or a plan to make sure you get there. And in this case, for a lot of people, that destination is having a wonderful retirement. But it takes having a plan and managing a lot of different aspects to make sure that you arrive there as you intended. So yeah, so those were a lot of good points. So those were 5 points, if I'm keeping track.
Those were the 5, yes.
Yes. So one of the mistakes is emotional decision making, right?
Yep.
Lack of diversification within the portfolio.
Yep.
And ignoring taxes and fees. I added fees.
Yep.
Failing to rebalance, right? And then not having a plan.
Yes.
Okay.
Yep.
So Cheri, I think those really are the top 5, and we see people who are making those mistakes all the time. In fact, that's it's a lot of DIYers that come to us, and say, hey, I'm looking for some active and professional management. So
who find that it didn't work out the way that they were hoping.
That's right. So hey, if you like this video, give us a thumbs up, and that way other people can help find this video as well. If you would like to see more videos like this, you can find us at clientfirstcap.com, and from there you can find a link to our videos. You can sign up for our monthly newsletter. Also, if you want to talk to someone, you can reach out to us or schedule an appointment from our website as well. So Cheri, thank you. This was a good topic.
Thank you, Cary. It was great.
Bye-bye.
Bye.